Good evening, everyone. Time for another silver update. This is the daily chart of the US dollar over the Chinese yuan. That's the Chinese currency, which is still essentially pegged to the dollar based on a fixed floating rate. It's allowed to move in bands, but again, it's a pegged currency. It's not freely tradable right now, but you can see a couple of things in this chart. I just want to point out that this is the signature that you see when you're talking about a rigged market. And of course, that's the problem that we have now in the entire world, especially in the United States, is that all of the markets are rigged. We have government intervention in markets, and the only thing that can happen as a result of governments intervening in markets is absolute disaster. That's what we're heading for. Now, if you look at this chart, you can see during the year 2010 from late 2009 through about June, we had this peg. This was central bank pegging of these exchange rates, and then you can see when the peg was finally broke, there was the breakdown, the reaction, and then of course the long downtrend. Now this sort of thing is this is normal market behavior. Then we come down here and we get the same thing here. This is another peg that the central banks have set where they're controlling, not allowing the currencies to freely be traded against each other. And of course that is unnatural because the fundamentals are going to dictate the value of currencies, relatively speaking. Now you can see they had a breakdown and then they had a trumped up rally, of course, that failed. That will always be the case. And now you can see where we are right now in the exact same situation. We have this artificial peg of the Chinese currency at 6.11 to the dollar. Now I've said for a very long time that this is going to one-to-one parity and beyond, and that's going to mean ultimately the death of the dollar. But just to think about these things, what does this mean? Now, a lot of talk has been given about how the Chinese are going to have to suffer tremendously as their currency strengthens. You have to remember that as your currency gets stronger, that means that your exports are more expensive and your imports are cheaper. So in this case, where the Chinese currency is strengthening against the dollar, that means that Chinese exports will become more expensive, exports to the U.S., and we pretty much import everything, and a large amount of it is from China. If you go to Walmart and just start looking at things, you can see how many are manufactured in China. That means that prices on those goods are going to go up as the Chinese currency strengthens. Now, if there were an equilibrium where it reached fair value, what you would start to see is an increase in manufacturing in the United States because it would become cheaper to manufacture the goods here. Obviously, that's not happening, so that is nowhere near reaching any kind of fair value. They're still propping up the dollar versus the Chinese currency. Now, the other side of that is going to be how the Chinese have cheaper imports. Now, that means oil. So as the Chinese currency strengthens, one of the main inputs they need, because they have all of the factories, is oil. And that means that oil is going to get cheaper and cheaper. And of course, we know that they're already doing bilateral trade agreements. There's the Iran and Syria thing going on. But if this trend continues, which I'm sure that it will, as I've said, it's going to continue all the way down to one-to-one and beyond, then that means that oil is going to get cheaper and cheaper and cheaper for the Chinese. And the manufactured goods, on the other hand, are going to be more and more expensive for the Americans, and I don't see that trend turning around. There's no reason for the Chinese to not be able to raise their prices on those. and be able to withstand those price increases because there aren't any competitors. There's no one else manufacturing. So this trend has a long way to go, and it would probably be a lot better if they just let the markets decide. We would be at a resolution much quicker. Now, here is another peg that we see here, an artificial peg, and this is the debt ceiling that's been set, and we know that the government is doing all kinds of shenanigans to keep the amount of money borrowed below the legal limit. So now the debt ceiling debate is heating up, and there's probably going to be a standoff between the Republicans and the Democrats. Of course, everybody's talking about whether the government should shut down. Well, there's no chance that they're going to shut down the government. Of course, that would be the best thing in the world that could possibly happen, is for them to shut down the federal government. Can you imagine if they had to shut down the FBI, the CIA, the DHS, the TSA, the DEA, all of these tax-consuming big brother entities? They had to bring all the troops home. So shutting down the federal government would be the best thing that could possibly happen. And of course, that's not going to happen. Now, I've got an article that I posted on the blog site, and this was just released today. This is the latest Charles Savoy. Charles Savoy is, I would say, the grandfather of silver conspiracies. He knows the history. He's documented the history. He doesn't just quote other people. He actually goes to the library, gets the original sources, gets the original quotes, and there's some amazing quotes in this. So let's read a little bit of this. Of course, this is a reaction to the CFTC decision to drop the silver investigation. I don't think Charles was surprised at all. Connivers figuring to cheat CFTC. What will they say when silver runs out? Now, we know that silver is going to run out because it's a rigged market. And anytime governments interfere in markets to suppress prices, then you're going to end up with shortages. And that's what we're going to end up with. So Charles is speculating about what's going to happen when that occurs. In October 2002, in Is the Silver Lie Ready?, I speculated the shorts, exchange officials, and regulators, when a silver delivery crisis hits, may attribute it to an Arab consortium who raided London of a huge amount of silver. I suggested the sum of 770 million ounces, as the LBMA is famed for its opacity. The LBMA features top-tier precious metals price antagonists, including Barclays, Goldman, HSBC, and Morgan Chase. Mine has been a very lonely voice in the wilderness since December 2004, saying, these entities are all represented in the Pilgrim Society of Great Britain and its Manhattan branch, and that this group constitutes the Central Committee of Synthetic Money Creators. Though difficult to quantify, I reckon that perhaps 15% of major metal sites have given this situation at least a trace of coverage, and the cause of absence of coverage is not because anyone challenged any part of the documentation presented. I remain one of two long commentators in silver to be cited by the Silver Users Association. The others have been disregarded. And it continues on. It goes into the hunts. Now you have to remember that the hunts were cracked down on by the government through the CFTC for silver manipulation, and there's always been crackdowns for long manipulation, but we never see crackdowns for short manipulation. So the manipulators can only be on the long side. They can never be on the short side, and we all know what they did to the hunts. So go ahead and read that article. It's very, very good, and there's a lot of historical information that you need to know there. Now, the latest Jim Willey is out. Jim Willey is indicating that the Treasury bond market is starting to crack. Now, this is the biggest bubble in the history of the world. If you look at the chart of the 10-year note, you can see here at 2.61%. Now, Jim is saying, and we'll read, he's talking about how they had to defend that 3% level. We know with this national debt and the interest rate on these bonds that if the interest rates start to rise on the government debt, then it could be an explosive situation. The interest payments could end up taking up nearly 100% of all of the tax revenues, which are not very large. They haven't been growing. They've kind of flatlined at about the 2.4 trillion number. So they've got to raise this debt ceiling, but they also have to keep these interest rates under control. You can see the very long-term trend line here that it's trying to break out of, but just this little tiny move we have here from the bottom of under 2% to near 3% is causing major crises in the derivatives markets. Now, back in 1994, you can see the spike that we had here went from just a little over 5% to 8%. Percentage-wise, it's about the same move. So we're talking about a similar crisis that we had there. They need to stop this interest rate from rising. So that's what this is about. I'll read a little bit here. Reverse of the U.S. T-bond carry trade. Make several conclusions right away. Panic has finally hit the U.S. Fed. They cannot defend either the U.S. dollar or its obverse, the U.S. Treasury bond, the trading vehicle. They are both at improper high valuations. Rising interest rates will cause more sales, the dreaded convexity to come into play. The big U.S. banks must unwind their leveraged U.S. T-bond carry trade based upon the bond futures contract. Watch big U.S. banks sell their leveraged positions that in the past 3 years provided them supposedly easy profits. The positions are locked in high leveraged structures. The breakdown of U.S. T-bonds and the U.S. dollar has begun, a long process having come full circle after the highly destructive ZIRP and QE, both ingrained in monetary policy. The breakdown in the currency and sovereign bond will be aggravated by interest rate derivative dismemberment and colossal losses. The U.S. T-bond and U.S. dollar duo breakdown is the visual impact and reaction to the gradual geopolitical isolation of the United States. It was seen in the glaring glimpse with Syria, a call to war, a refusal, and the U.S. looking like a deceptive player with bloodlust. The world is reacting to misguided monetary policy maintained by the U.S. Fed that supports the Western banks in toxic bond redemption, but causes nasty problems across the world in higher food prices. As the U.S. Fed and its devoted big U.S. banks conduct bond trading among themselves, the left hand selling to the right hand, it becomes more evident that U.S. T-bond asset bubble is being revealed. The irony is that the aggravating factor is the big U.S. banks unwinding their bond carry trade. Their leveraged sales will result in overshoots in the bond yield called convexity in the trade. Beware of convexity and its destructive impact. So there's a lot of things pointing to a crisis that's just around the corner here. We've got this interest rate chart that is looking like it wants to break out. If this breaks out, we're talking about a massive crisis in the bond market and a massive crisis, of course, with the national debt. Now, we've got this debt ceiling debate. We've got Obamacare being held hostage in this, and that's going to be very dramatic, whichever way it goes. And we've got the Syria situation, and we've also got all kinds of crazy stuff going on with the CFTC and their decisions regarding silver. So let's go back to the silver chart and look at where we're at here. Now, I wanted to point out that with the junk silver premium that we're currently seeing, which is beginning to compress, if you remember during this time of this downtrend, I was following the junk silver premium. When we got this smackdown right here in the June time frame, that's when the junk silver premium exploded to about $3 and above. Normally the premium on junk silver is about even with spot or below spot, so that's a normal historical premium for junk silver. Now we went above $3 and now we're beginning to correct. You can see here on APMEX we've got $1,000 face bag 90% silver coin, and it's about $1.79 over spot. So that's still historically very high for spot silver, for junk silver over spot. That's still going to prevent the recycling that you normally see with the coin shops. As I pointed out before, when the silver comes into the coin shops, usually they take it and they sell it back to the refiners for below spot. If we see a significant premium above spot, it's much more likely that the coins will actually go back out as junk silver and not be melted down and refined. That's going to cause that number of recycled ounces to be lower going forward. We usually see about 1 billion ounces of silver, at least that's what the Silver Institute reports, but the mining supply is only about 750 million ounces. So as that junk silver is not recycled into that, then that number is going to go down much farther below 1 billion than it has been in the past few years, because we've really never seen a premium, a sustained premium on junk silver. So we want to watch that very closely. Nevertheless, at $1.79, we're given an effective price of silver about $1.25 lower, just because we were about $3 above spot in the past. So looking at the chart, that $1.75 actually brings us down to an effective price of about 19. So really, looking at junk silver right now, it is about as cheap as it has ever been, even when it was down here around 18 or so. It really is as cheap as you've ever gotten it, and it's something that you just really, in my opinion, you're not going to be able to lose on. You have to remember that we're coming to a crisis here. We've got the debt, we've got the bonds, we've got the Fed, we've got all these things coming to a crisis. Now, we had reports today that there is a bank holiday in Panama. A lot of people are speculating that that is a trial run, and that they're going to open next week and everything will be fine. Of course, that will begin to train the people to get used to having bank holidays, and then when the big one really hits, they're going to be caught flat-footed and they're not going to have anything, and then they will revalue the currency. So that's why you want to be in physical silver. It is a hedge against inflation, but even more importantly than being a hedge against inflation, it's a hedge against default. You want to have a lot of gold, a lot of silver, a lot of preps, and some cash just in case they close the banks, and you'll be ready for the crisis when it hits. And we'll talk to you next time.